Assalamualaikum Doctor, my name is Nurul Edina Atira binti Zakarani. My metric number is 30925. So today I will present about the internal and external factor of the credit risk of the citizen financial group. So the main issue of this study is that although banks often blame economic conditions such as inflation and GDP growth for increasing credit risk, it is still unclear that whether internal bank factor or external bank factor have a greater influence. So therefore, this study has three objectives. First, to identify the internal factor affecting credit risk. Second, to identify the external factor affecting on the credit risk. And third, to identify the combined effect of both internal and external factor. So the research questions are developed based on this objective. And the hypothesis proposed that internal factors external factors and the combination of both factors may influence the credit risk of citizen financial group. Moving on to the literature review, according to the Basel Committee on Banking Supervision 2002, credit risk arises when borrower fails to meet their debt obligation. In this study, credit risk is measured using the non-performing loan ratio calculated as NPL divided total loans. Next, according to the Atanasoglu, Brice, Smith and Dalis 2008, bank-specific factors such as profitability, capital strength, and operational efficiency play an important role in determining a bank's financial performance and risk exposure. Therefore, this study examined ROA, ROE, liquidity, loan yield ratio, regulatory capital, leverage ratio, capital adequacy ratio, and firm size as the selected internal variable. For external factor, according to the Castro 2013, GDP growth, inflation, and interest rate influence borrower repayment ability and the quality of bank loans portfolio. Therefore, the study used GDP growth, inflation rate, interest rate, exchange rate, unemployment rate, reserve money M1 and M2 as external variable. This study used secondary data collected from the annual report of Citizen Financial Group, so covering a period of 10 years from 2015 until 2024. Therefore, the study consists of 10 observations. The data were analyzed using IBM SPSS statistic. Multiple union regulation based on the ordinary least square approach was applied to examine the relationship between the independent variable and credit risk. So, three regression models were developed. Model 1 investigate the effect of internal factor on credit risk. Model 2 examine the impact of external factor. Finally, Model 3 combines both internal and external variable to determine their overall influence on credit risk. Based on the descriptive statistic, the mean value of credit risk is 0.0092. Since credit risk is measured using the non-performing loans ratio, this means average only 0.92% of Citizen Financial Group total loans were non-performing between 2015 and 2024. This indicates that the bank maintained a relative low level of credit risk throughout the study period. Next, based on the percent correlation analysis, ROA has the most significant relationship with credit risk. It shows a moderate negative correlation with a correlation coefficient of negative 0.586, indicating that as profitability increases, credit risk tends to decrease. This relationship is statistically significant. In contrast, GDP growth shows a weak positive correlation with credit risk with a coefficient of perimeter 0.049. This relationship is not statistically significant, suggesting that GDP growth has little influence on the bank credit risk during the study period. Based on the model summary, Model 1 has the highest adjusted R-square value of 0.936. This indicates that 93.6% of the variation in the independent variable credit risk can be explained by the internal factors included in Model 1, namely ROA, liquidity, LYR, regulatory capital, and leverage. The remaining 6.4% is explained by other factors outside the model. In comparison, Model 2 has an adjusted R-square of negative 0.170, while Model 3 record only 0.008, indicating that this model have much lower explanatory power. Therefore, Model 1 is the most powerful model for explaining credit risk in this study. Based on the ANOVA result, Model 1 is statistically significant because its p-value is 0.003, which is less than 0.05. This means that the internal factor collectively have a significant effect on credit risk, and the regression model is suitable for explaining the dependent variable. In contrast, Model 2 and 3 are not statistically significant because their p-value are greater than 0.05. This indicates that the selected external factors as well as the variable combined in Model 3 do not collectively explain credit risk during the study period. So let's look at the final regression result to identify what actually drive our dependent variable, which is credit risk. Looking at all three frameworks, Model 1 of our bank-specific model is the only one with statistically significant result. First, leverage is our most significant positive driver with a B coefficient of 0.021 and p-value of 0.001. This proves that higher debt level encourage banks to build up their capital buffer to meet regulatory demands. Second, ROA has a strong and significant negative impact at negative 0.499. This is consistent with pecking order theory, which suggests that highly profitable banks prefer to grow asset aggressively or use internal funds rather than hold high capital ratio. LYR is also significantly negative at negative 0.117. In contrast, Model 2 for microeconomic factor and Model 3 for structural risk show no significant result at all, with all p-value well above 0.05. Therefore, it clearly shows that the internal management characteristics of a bank have a much greater impact on its credit risk profile than changes in external macro environment. In short, risk management is an internal discipline, not an external variable. I can firmly conclude that enforcing effective credit controls, optimizing asset allocation, and maintaining strong leverage rules are the most reliable ways to keep loan default rates to an absolute minimum. Based on the above, there are two recommendations that can be effectively implemented. First, banks should ensure that there are stricter criteria for screening their assets to maximize their internal ratios from the outside. Second, bank management should actively monitor and manage their internal leverage ratio and equity multipliers. This ensures that the institution's equity buffer is always well protected from sudden shocks. So I think that's all from me. Thank you, Doctor.